Chapter 5. Do Your Own Research. DYOR is a call for investors to take responsibility for their own investment decisions and to conduct thorough due diligence on the projects they plan to invest in. I'm starting this chapter with a story that became a true entry point for me into deeper research on crypto projects and the formation of my own approach to evaluating them. Long before terms like blockchain, DeFi, or decentralized protocols entered my vocabulary, it all began with a simple human curiosity about individual assets whose names I first heard in conversations with colleagues. These informal discussions, without any clear goal or structure, unexpectedly became the foundation of my analytical journey. We talked about developments in the digital space, the shortage and rising prices of graphics cards, and shared impressions about Bitcoin and its volatility. But there was one name that kept appearing in almost every conversation, again and again. It was the XRP token from Ripple. One of my colleagues, an early enthusiast of the project, could talk about it for hours with genuine excitement. He explained the network's architecture, its potential in interbank transfers, and how this asset could reshape financial infrastructure. One idea he repeated very clearly: XRP would inevitably reach the $1 mark. At the time, this sounded bold, and at times even almost fantastical. Still, his confidence and the internal logic of his arguments were compelling enough that I felt the need to understand it myself. That was the moment my first intentional research began. I started reading, analyzing, comparing, and diving not only into Ripple but also into other projects as well, gradually realizing that behind every token is far more than just a price chart. It was a transition from surface-level interest to a systematic approach. 2 years later, in 2017, XRP did in fact reach the $1 level, the very milestone my colleague had spoken about with such confidence back in 2015. For me, this became an important internal turning point. I clearly realized that a deep understanding of technology, project logic, and its place within a broader system allows you to anticipate developments. It is not about guessing price movements, but about recognizing fundamental value and potential before the majority does. That is how my real study of the world of digital assets began, and the formation of my own vision of the industry's future. Sometimes, everything starts with a single coincidence that becomes a turning point.
Part 1. Do your own research. When a new, promising project name starts circulating in the information space, one that's supposedly about to list on a major exchange, and people in your communities are enthusiastically discussing its upside, it's very easy to believe you're looking at a unique opportunity. In moments like these, it feels like all the stars have aligned and the market itself is signaling the right move. This is exactly where one of the most common traps for beginners lies. A sense of urgency kicks in, along with the fear of missing out, FOMO, and the conviction that this is the perfect entry point at the lowest possible price. In reality, this kind of emotional logic often leads to decisions you later regret. The outcomes vary, from partial losses in a milder scenario to a complete wipeout of capital accumulated over years. That's why the ability to pause, step back from the hype, and engage a rational mindset is critical. The core rule is simple, yet often ignored. Always do your own research. DYOR. Most new investors underestimate the true value of this approach. Analysis is often postponed or skipped entirely, as if it doesn't really matter.
From my experience, this is one of the most dangerous gaps in thinking. The sooner you learn to close it, the lower your chances of ending up in a project sustained purely by headlines and short-term hype. To better understand the importance of pre-investment analysis, let's look at two vivid examples. Meme coin Trump, Solana, 2025. After January 17, 2025, just days before the inauguration, Donald Trump, already elected President of the United States, became associated with the launch of the Trump meme coin on the Solana network. The initial price ranged between $7 and $8 per token. The total supply was 1 billion tokens, but only 200 million were made available to the public during the initial offering. The rest remained under the control of affiliated entities with privileged access to the project.
Hype quickly accelerated on the social platform X, and the following day it was amplified by public statements from Donald Trump himself. For many, that was enough to enter the asset without asking deeper questions or analyzing the project's structure, token distribution, or potential risks. Within just 24 hours, the price of Trump surged from $7 to $8 to approximately $75. This triggered a wave of excitement and the feeling that the market had just created another golden opportunity. But the euphoria didn't last long. By January 19th, the price began correcting rapidly, dropping to around $37. Through February and March, the decline continued, eventually stabilizing near $10. The outcome was predictable. Social media quickly filled with stories from investors sharing their experiences. For many, it was painful. People invested under emotional pressure, trying to catch the last train they believed would deliver quick and easy profits. I observed the consequences not only online, but also within my own circle. There were real cases where acquaintances lost a significant portion of their savings. The reason was simple and telling. They trusted a high-profile name, the project's official image, and its public backing without taking the time to analyze its structure, token allocation, or possible scenarios. As of late 2025, the official Trump token continues trading on exchanges within the Solana ecosystem as well as on Coinbase at around $5, with a market capitalization of approximately $1 billion. At first glance, these metrics may seem like proof of the project's viability, but this is exactly where deeper analysis is required. One particularly revealing detail: in January 2025, 8 of the top 10 centralized exchanges listed Trump in an extremely short time frame. On average, listings occurred within 48 hours, whereas the standard due diligence process for new assets typically takes around 129 days. This kind of speed is highly atypical behavior from exchanges and deserves scrutiny. Stablecoin Luna, Terra, 2022. Another high-profile case that left a lasting mark on the crypto community is the collapse of the Terra ecosystem and its stablecoin UST in 2022. At the time, the project looked exceptionally attractive, a standalone blockchain focused on decentralized finance with its own ecosystem of services and, most importantly, an algorithmic stablecoin pegged to the US dollar. UST's peg mechanism wasn't backed by real reserves, but relied on its relationship with the Luna token. When demand for UST increased, Luna was burned. When demand dropped, additional Luna was minted. In theory, this model was designed to function as a self-regulating system. There was also a highly attractive yield component.
The Anchor protocol, closely associated with the Terra team, offered nearly 20% annual returns via staking. For many investors, this looked like the perfect combination of innovation and stable income. The problems began when UST lost its dollar peg. Events unfolded like an avalanche. Investors rushed to exit UST, swapping it for Luna. This triggered a massive increase in Luna's supply and an immediate price collapse. Within days, tokens that had recently been valued above $100 effectively became worthless, dropping close to zero. The result? Billions in losses and thousands of investors left with completely devalued assets. Both examples, Trump and Terra Luna, clearly demonstrate why understanding a project's internal structure is critical. You need to know who is behind the project, how decisions are made, where control is concentrated, and what truly underpins the economic model. In the case of Trump, a significant portion of the supply was controlled by affiliated entities, creating the potential for manipulation from the outset. Terra went even further. The UST stablecoin model had no real backing in fiat reserves or stable assets. The entire system depended on its algorithmic link to Luna, which proved fragile under market stress. When control over an asset or its key mechanisms is concentrated in the hands of a few, it almost always signals elevated risk. Sharp price volatility, opaque decision-making, and unpredictable outcomes for retail investors become the rule, not the exception. At this point, you should already be forming a foundational understanding of why DYOR is not just a formal recommendation, but a real risk management tool. Before buying any asset, it's worth honestly answering a few simple but critically important questions. Who exactly issued this token? Who controls the majority of the supply? What is the vesting or unlock schedule? Is the team public, and is there a clear roadmap? Does a real product exist, and what tangible value does it create? Even this basic checklist can help you avoid decisions driven by emotions and social media hype, and, as a result, avoid financial losses. The deeper your understanding of a project's structure, the lower the likelihood that you'll end up serving as exit liquidity for other market participants. All of these examples lead to one simple conclusion. The market does not reward belief in names or loud promises. It rewards an understanding of fundamental value. Hype can create the illusion of opportunity, but only fundamentals provide a real chance at long-term success. That's why proper research starts not with emotion, but with a clear, rational analysis of a project's structure, incentives, and intrinsic value. The only thing that consistently works in an investor's favor is structured thinking and investment in their own knowledge. The deeper your understanding of the underlying processes, the less room there is for impulsive decisions and external manipulation. In this chapter, we will build a foundational toolkit and analytical framework to help you transform chaotic information noise into a clear, structured perspective and make decisions from a place of awareness, not reaction. Part 2. Market Scanning. Conducting a top-layer information scan. Step 1. The process of market evaluation can be described as a dual-factor approach, which I refer to as a parallel model. The top layer of this model focuses on analyzing the broader digital landscape within a specific market cycle or stage of industry development. At this level, you're working with a wide range of sources: analytical reports from leading investment funds, news coverage, independent research, and key narratives discussed at global industry conferences. This perspective allows you to identify major trends, structural shifts, and strategic vectors that shape current market dynamics and define the future direction of the digital asset ecosystem. To better understand this approach, it's helpful to briefly look at previous industry cycles. During the 2015 to 2018 period, we saw the emergence of new blockchain platforms and the early formation of the decentralized finance sector. This was a phase of large-scale experimentation with network architecture, smart contracts, and financial primitives, laying the groundwork for more mature solutions and broader adoption. The next cycle, from 2019 to 2021, introduced a different set of dominant trends. The market was overtaken by the explosive rise of NFTs and the concept of the metaverse. These developments didn't just shift attention, they created entirely new modes of interaction between digital assets, culture, gaming environments, and virtual identity.
The current cycle, which began in 2022 and continues today, has introduced new segments into the digital landscape. Among the most prominent are RWA, real-world asset tokenization, and AI integration, including the incorporation of artificial intelligence into smart contracts, DAOs, generative platforms, and new models for analytics and forecasting. These innovations are gradually reshaping how digital projects are managed and how decisions are made. These directions consistently remain at the center of industry attention. They dominate headlines in specialized media, are deeply analyzed in research reports, and are actively discussed across professional communities and social platforms. At its core, the top layer can be distilled into one key principle: focus on the innovation component. It either creates an entirely new market segment, driving technological breakthroughs, as with tokenized real-world assets, or significantly accelerates the development of existing verticals, such as smart contracts, blockchain protocols, or DeFi. A strong indicator of potential is sustained interest from multiple stakeholders: users, developers, media, venture capital, and industry thought leaders. At the same time, it's critical to recognize that the digital asset space is saturated with noise. Every day brings dozens of new hypotheses, announcements, and so-called hot trends, many of which lack real fundamental value. Examples of this noise include meme tokens with no technological or economic foundation, assets with no clear use case created purely for speculation, such as the Trump token, event-based betting platforms with questionable long-term viability or weak integration into the broader digital ecosystem. That's why one of the key skills at this stage is the ability to filter out secondary narratives and focus on trends that create long-term value or serve as foundational infrastructure for future growth.
In this context, simple but powerful questions become essential. What problem does this emerging segment solve or improve? What are its long-term prospects in real-world or digital contexts? These questions help distinguish hype from fundamentals and build a structured evaluation framework, from technological potential to long-term socio-economic impact. Step 2. Once you've identified promising directions, the next step is to move to a parallel layer of analysis, examining where venture capital and institutional money are flowing. These players often shape the primary vectors of industry development and lay the foundation for future trends. At this stage, focus on analyzing funding rounds. Which sectors are attracting the most capital? Where is funding consistently being deployed? Which projects are gaining the trust of institutional investors? This approach provides insight into which market segments are considered strategically important in the medium to long term. Special attention should be given to Tier 1 investors, leading venture funds that not only deploy significant capital, but also actively shape market narratives and strategic direction. These include firms such as Coinbase Ventures, Hashkey Capital, Galaxy, and others, whose involvement often signals strong potential in a project or sector.
In the current market cycle, starting in 2022, several key sectors have attracted the most funding.
1. Infrastructure. New blockchains, scaling solutions, Layer 2 protocols, and cloud-based blockchain services that form the backbone of ecosystem growth. 2. DePIN, decentralized physical infrastructure networks. Telecommunications, energy, compute, and data networks where blockchain coordinates and incentivizes participants. 3. AI plus blockchain convergence. Integration of AI into Web3 protocols, including generative systems, autonomous agents, and advanced analytics, reshaping data management and decision-making. Another critical skill at this stage is understanding market cycles. Knowing which phase a trend or narrative is in allows for significantly more informed investment decisions. Helpful guiding questions include: is the trend in its early emergence phase? Is it experiencing active growth? Has it already matured into a fully developed segment of the digital landscape? In my view, this stage is foundational. It establishes the baseline from which a beginner begins to build a structured understanding of the market. This was also my own path. From your current vantage point, you can already evaluate past trends, seeing which lived up to expectations and which did not. At the same time, you can identify emerging narratives that are still early but show clear potential for future integration. The ability to connect past, present, and future perspectives is the foundation of strategic thinking in digital asset markets. Understanding whether a technology or segment is at inception, growth, or maturity provides a clear view of the risk-to-reward ratio. This is similar to investing in real estate during early construction stages. The risks are higher, but so is the potential return. The same applies in digital markets. Recognizing the right phase early opens access to opportunities long before they become mainstream. Step 3. After completing the previous steps, you should already have identified specific segments and categories that are attracting significant capital and strong venture support. The next step is to conduct a detailed screening of these areas using leading digital asset market aggregators. Start by analyzing active projects within the selected segment. This helps you understand the current competitive landscape, identify strong players with solid fundamentals, determine which blockchains, ecosystems, or protocols serve as the foundation for development within the segment. Next, analyze emerging projects launched in the current cycle. This provides insight into how the segment is evolving, highlights innovative approaches, and reveals early-stage trends approaching broader adoption. These insights can be systematically organized using aggregator platforms through sections like categories and subcategories, specific verticals such as RWA, AI, DePIN, Layer 2, etc. Finally, evaluate early-stage projects still in funding or development phases. Use aggregator sections such as fundraising, deal flow, token sale calendar. These tools allow you to track who is investing, which funding rounds have been completed, what stage of development or launch each project is in.
It's also important to cross-reference data across multiple sources to minimize bias and build a more objective market view. This three-layered approach builds a critical skill, the ability to construct a structured, data-driven understanding of a chosen segment and make informed decisions. It helps answer key questions. Which active projects are segment leaders, and how sustainable are they? What new and promising projects or blockchains have launched or are preparing to launch? Are new projects evolutionary improvements or true breakthroughs solving real problems? Has the segment reached maturity as a stable and fully formed part of the digital landscape? Each of these questions helps assess the development level of a sector, understand its fundamentals, identify emerging players, and determine whether they deliver genuine innovation or simply reinforce existing solutions. As you continue practicing and exploring the market, you'll discover remarkable projects, ecosystems, and global narratives. That's the core objective of market research. If new projects enhance existing solutions, for example, Layer 2 scaling solutions for Ethereum, the next step is to move to the lower layer of analysis, focusing on a deeper evaluation of their real impact on the ecosystem. This includes analyzing their interaction with base layer protocols, adoption levels, and their ability to scale efficiently without compromising performance.
Part 3. Fundamental Analysis. We now move into a deeper scan of the underlying information layer. White paper. At this stage, you already have a short list of specific projects that have captured your attention, along with a general sense of their potential and innovation within the digital landscape. However, this is still not enough to make a well-founded decision. To transform an initial, somewhat abstract assessment into a clear and strategically grounded understanding, we move to the lower layer of our two-factor model, the deepest and most critical level of analysis. This is where in-depth research of potential projects takes place, involving a thorough evaluation of their fundamental strength, technical viability, and market positioning within selected segments. This approach helps avoid superficial conclusions and ensures that the final selection aligns not only with a long-term vision, but is also fundamentally sound at the level of each individual project. A key skill in this process is the ability to filter out short-term informational noise and focus on truly meaningful growth drivers. That's what allows you to concentrate on projects with not just current relevance, but genuine long-term growth potential.
The central tool at this stage is the official technical document, the white paper. It enables you to analyze a project from multiple angles, from technological innovation to economic viability, and its role within a broader ecosystem. In essence, a white paper is a research document that comprehensively outlines both the technical and economic aspects of a digital project. It is created directly by the development team and is designed to explain the problem the project solves and the proposed solution, and to serve as a guide for potential investors, users, and partners. Additionally, it reflects the team's mindset, strategic vision, and level of execution, critical elements when assessing a project's credibility. For a white paper to be truly informative and valuable for analysis, it should meet several core criteria. 1. Sufficient depth. Typically no fewer than 10 pages, ensuring all key aspects are covered with the necessary level of detail. 2. Comprehensive project overview. Clearly defined objectives, origin context, role within the digital environment, and long-term vision. 3. Technological core. A detailed description of the architecture, performance, security model, and underlying protocols. 4. Functionality. Real-world use cases across both Web3 and traditional environments. 5. Economic model. Special attention to tokenomics if a token is involved, including distribution, inflation mechanisms, utility, and incentive structures. 6. Development strategy. Current project status, roadmap, implementation phases, and long-term objectives. Beyond the core structure, it's important to consider additional parameters that help evaluate the quality of technical execution.
Help evaluate the quality of technical execution. 7. Network architecture. Levels of reliability, scalability, security, and decentralization. 8. Consensus mechanism. Type, efficiency, and resource consumption. 9. Innovation. The project's ability to introduce new solutions or significantly improve existing approaches, such as integration with AI. 10. Ecosystem. Availability of developer tools, an active community, open source code, clear documentation, and the presence of SDKs and APIs. 11. Compatibility. Interoperability with other networks and systems directly impacts the project's practical value and integration potential.
A comprehensive approach to analyzing a white paper allows you to filter out superficial and speculative ideas, focusing instead on projects with real technical foundations, well-designed economic models, and realistic implementation strategies. This is a critical step for anyone aiming to make decisions based on structure and data, not hype. Some teams also publish a shortened version of the document, a light paper. This is a simplified format for a broader audience, but it should still include key elements: a clear vision, implementation plan, technical foundation, market understanding, and proposed solutions. Even from such a document, you can form an initial judgment on whether the team is genuinely building an innovative product or simply trying to ride a wave of market hype without a real strategy. It's worth emphasizing that having a full-fledged white paper prior to a project's launch is one of the key indicators of its seriousness. If such a document is missing, or if it reads more like a marketing brochure without substantive technical and economic depth, that's a clear signal not to invest your time or capital in the asset. At this level, another critically important skill begins to take shape: the habit of working systematically with technical documentation. This skill enables you to evaluate a project's real potential, its scalability, and its readiness for integration into the future digital landscape. Team composition. Within the framework of fundamental analysis, special attention should be given to the team behind a project, as their experience, expertise, and stability often determine its success. First and foremost, it's essential to evaluate key individuals, particularly executives and technical leaders. The goal is to understand whether they have a proven track record in the crypto industry or related fields, what projects they've previously built, and how successful those initiatives were. This typically involves analyzing open sources, professional profiles, public appearances, and participation in industry events, including content available on streaming platforms. It's equally important to assess the size and stability of the team. Sudden downsizing after launch can be a red flag, signaling internal issues. A critical indicator is actual development activity, which can be tracked through the frequency and consistency of updates in public repositories. Adherence to the stated roadmap is another strong signal of organizational discipline and accountability. The technical stack also plays a key role. Widely adopted programming languages provide access to a larger developer base and proven solutions, making scaling more efficient. At the same time, emerging languages may indicate innovation potential and the formation of a new technological wave. In this context, it's also important to evaluate the availability of SDKs, APIs, technical documentation, hackathons, and educational initiatives, all of which shape the accessibility and attractiveness of the ecosystem for developers. Another important factor is the presence of advisors and partnerships with recognized organizations or institutional players. These relationships can enhance credibility, but they should be verified through actual activity, public mentions, and participation in joint initiatives, not just logos displayed on a website. Governance structure also deserves close attention. If a project claims decentralization, it's important to assess how this is implemented in practice, whether voting mechanisms exist, and how key decisions are made. A realistic and consistent roadmap further reflects the project's maturity and strategic clarity. Ultimately, a team is more than just a list of names. Their experience, consistency, technical activity, transparency, and engagement with the community must all be carefully evaluated as part of your DYOR process to form well-grounded conclusions about the project's long-term potential. Project Tokenomics. At this stage, an attentive reader or a more experienced researcher may naturally raise a question about the role of tokenomics, and that's entirely justified, as it is one of the core components in evaluating any digital asset. The financial model directly impacts the project's growth trajectory, the incentives of ecosystem participants, and its ability to scale under real market demand. Tokenomics determines whether a project can sustain long-term interest, maintain liquidity,
and ensure stability and overall investment appeal. Without a clear understanding of the underlying economic logic, it's impossible to objectively assess an asset's viability, even if it's backed by a strong team and cutting-edge technology. That's precisely why tokenomics deserves a separate and in-depth analysis. In the next section, we'll take a closer look at its key elements, including distribution models, inflation mechanisms, incentive structures, the functional role of the token within the ecosystem, and the associated risks. Market potential assessment. This stage is a logical continuation of the key question raised in the third step of the upper layer. Which projects are already segment leaders, and how sustainable are they in the long term? This is where the analysis deepens through comparing emerging solutions with established players, evaluating their competitiveness, unique advantages, and ability to complement or transform the existing market landscape. Market potential assessment, as a component of fundamental analysis, helps determine the real prospects for scalability, profitability, and long-term viability. It takes into account not only the project's internal fundamentals, but also its ability to integrate into existing markets, or to create entirely new ones. First, it's important to identify whether the project is an autonomous blockchain solution building its own ecosystem, such as SUI, or if it operates within an already established ecosystem infrastructure, like Ondo on the Ethereum network. Once the project type is defined, the next step is to evaluate the scale of the market it aims to capture, its TAM, total addressable market. This can range from a narrow niche, such as GameFi, wallets, or specific Web3 services, to broader infrastructure solutions, including Oracle protocols or cross-chain bridges within DeFi. Assessing TAM provides insight into the potential user base, application scope, and overall growth runway. In most cases, new projects begin within niche segments, where they can test their product under real market conditions. Successful execution opens the path to scaling, expanding into broader markets, and gradually building a full-fledged ecosystem, one that fosters the emergence of additional specialized solutions and complementary projects.
It's also critical to consider one key factor. If a new project is developed within an established ecosystem, it gains immediate access to existing infrastructure, users, and liquidity. This significantly enhances market reach, improves financial resilience, and accelerates growth. Conversely, if the project is autonomous, it requires strong backing from investors, substantial financial resources, and the ability to compete with already established players to achieve sustainable development. Selection metrics. At this stage, the analysis shifts toward a deeper understanding of the project and a critical validation of whether its ambitions and ideas are supported by a real technological foundation. It's essential to assess the state of the network, the stability of its core components, and the system's ability to handle load, scale efficiently, and integrate into the broader digital landscape. Objective technical indicators help filter out informational noise and distinguish genuine activity from superficial signals, allowing for a more accurate evaluation of a project's long-term development potential. Core metrics provide a fast and structured way to assess the scale and momentum of an ecosystem, compare multiple solutions, and identify the most promising candidates for deeper analysis. Based on these metrics, the next section introduces the key indicators that form the foundation of market and financial analysis, ultimately enabling well-informed, data-driven investment decisions.
We continue the deep scan of the lower layer, relying on core indicators applicable across all types of projects. Market capitalization. Market capitalization is calculated as the current token price multiplied by the circulating supply. It reflects the total market value of a project and helps assess its scale within the digital ecosystem.
For ecosystem-based blockchains, market capitalization also serves as an indicator of the overall development and maturity of the ecosystem. At the same time, a lower market cap may signal significant growth potential, especially if the project operates within a high-potential, rapidly expanding segment. Practical guidelines for evaluating market cap. $5 million to $50 million, typically considered early-stage investment opportunities. $20 million to $50 million, characteristic of projects that have moved beyond the initial phase but still retain substantial upside potential. Above $10 billion, generally indicates a mature asset with strong investor confidence and a leadership position within its segment. Fully diluted valuation, FDV, a metric that reflects the project's potential total value under the assumption that all tokens, either already in circulation or scheduled to be released, are fully unlocked. It is calculated as the current token price multiplied by the maximum total supply defined by the Tokenomics. Comparing FDV with market capitalization is a critical component of fundamental analysis, as it helps assess inflation risk, potential investor dilution, and the project's true scale at its current stage. When FDV is close to market cap, it indicates that most tokens are already in circulation. In this scenario, inflationary pressure is minimal or non-existent, and dilution risk for new investors is low. This structure is typical of mature projects, such as Bitcoin, where the majority of issuance has already occurred. If FDV significantly exceeds market cap, it suggests that only a small portion of tokens is currently circulating. The remaining supply may enter the market through unlock schedules, future emissions, or incentive programs, creating inflation risk and potential downward pressure on price. This situation is most commonly observed in early-stage projects, particularly within DeFi and GameFi segments. Practical rule of thumb. FDV to market cap ratio above 3 to 5x signals significant future token supply expansion and increased price risk. A ratio close to 1 indicates that most tokens are already circulating, with minimal dilution risk for investors. Trading volume, a metric representing the total value of all buy and sell transactions of a token over a specific period, most commonly within the last 24 hours. It can be analyzed both on individual exchanges and in aggregate across the entire market, providing a clear view of an asset's real liquidity level. For large cap and highly capitalized assets, trading volume is an especially important indicator. Even with a high market capitalization, low trading volume may signal declining market interest or artificial price stability without genuine demand. Comparing trading volume with market capitalization helps assess liquidity and overall market attention. A high trading volume relative to market cap indicates that the token can be easily bought and sold without significantly impacting price. This typically reflects active participation from large market players, heightened trader interest, or a phase of active position redistribution. Moderate and stable trading volume, especially in already established projects, often suggests price range support by market makers and the formation of an accumulation zone. This condition is commonly observed during consolidation phases preceding potential upward or downward momentum. Low trading volume signals weak interest in the asset. In such conditions, entering or exiting positions becomes more difficult, and even relatively small trades can cause sharp price fluctuations. This increases volatility and creates a favorable environment for manipulation, particularly in small-cap projects. Practical rule of thumb. High trading volume to market cap ratio above 10% indicates active trading, strong liquidity, and significant market interest. Mid-range, 1 to 10%, reflects moderate liquidity and stable but not peak interest. Low ratio, below 1%, suggests weak trading activity, declining interest, or that the project is in stagnation or decline. Number of unique token holders. A metric that reflects the number of distinct addresses holding a token in their wallets. The higher the number of such addresses, the broader the distribution of the asset among users and investors. This generally indicates a lower level of centralization and a reduced risk of price manipulation by large holders. It is important to note that the number of addresses does not equal the number of real users. However, the growth trend in unique wallets remains a meaningful indicator of interest and engagement with the project. At the same time, it is important to consider the project's development stage. In early-stage projects that have just entered the market, a significant portion of tokens may still be locked according to the tokenomics model. In such cases, temporary concentration of assets in certain wallets is not necessarily a negative signal and often reflects technical or economic constraints embedded at launch. An increasing number of unique holders combined with a gradual decrease in token concentration among large wallets is a positive signal for the long-term stability of the project. Practical rule of thumb. A share of tokens held by the top 10 or top 100 wallets above 70% indicates excessive centralization. Above 50% signals a high concentration risk. Below 50% is considered moderate. Below 30% typically reflects a well-decentralized and more resilient ownership structure. DeFi project evaluation metrics. Since this sector aggregates digital financial services and offers a broad range of financial instruments, it is essential to analyze both the efficiency and real-world outcomes of their usage at the level of individual blockchain networks, as well as across entire ecosystems. Total Value Locked, TVL. This metric represents the total value of assets locked within a protocol. Depending on the financial instruments used by the project, these assets may be staked, for example, in the case of Lido, placed in liquidity pools, as on Uniswap, or supplied to lending platforms, particularly within ecosystems such as Avalanche. TVL is a key indicator of a protocol's scale and the level of user trust in the network. For mature and consistently active projects, special attention should be paid to TVL dynamics. Sustained growth or stable retention of TVL signals protocol reliability, while sharp fluctuations may indicate technical issues, loss of user confidence, or mass liquidity withdrawals, often associated with seasonal cycles and profit-taking events. When evaluating early-stage projects with low TVL, it is important to analyze the growth rate over a defined period, monthly, quarterly, or yearly. Consistent positive dynamics in this context indicate active liquidity inflows and strong potential for further development. Analyzing the relationship between market cap and TVL helps assess the balance between a token's market valuation and the actual capital deployed by users. This provides insight into both trust in the protocol and its financial stability.
Market cap reflects the total market value of a project based on the current token price and circulating supply. TVL, total value locked, represents the actual amount of user funds deposited into the protocol, such as staking, liquidity pools, or lending platforms. If market cap significantly exceeds TVL, it may indicate that the asset is overvalued by the market. In other words, the token price is higher than the actual user-backed liquidity, creating increased downside risk in case of declining interest or weak protocol activity. This situation is often observed in newer projects or narrative-driven assets, where investor expectations exceed actual user participation. Conversely, if market cap is lower than TVL, the project may be undervalued. This suggests that users have already committed significant capital, but the market has not yet fully reflected this value.
In such cases, the token may have upside potential, while the protocol demonstrates strong user trust and capital backing. Practical rule of thumb: below 1, market undervaluation; 1 to 3, fair market valuation; above 3, overvalued project. A supplementary metric for assessing speculative interest in a token is trading volume. It reflects the buying and selling activity of the asset on the market and helps evaluate its liquidity as well as the risks associated with entering or exiting positions. A key element in volatility assessment is the market cap to trading volume ratio. The higher this value, the higher the potential volatility tends to be. At the same time, sharp changes in trading volume may indicate increased market participant interest. An important exception applies to projects ranked within the top 15-20 by market capitalization. They may show a relatively low volume ratio, below 5% of market cap, while still maintaining high absolute liquidity and safe trading conditions. Practical rule of thumb: above 10% of market cap, sufficient liquidity; below 5% of market cap, low liquidity risk; above 0.5% of market cap, sufficient liquidity, only high cap projects and above. Special attention should be paid to both daily and 30-day trading volumes. Daily volume reflects short-term market activity and serves as a fast indicator of the asset's current state. In contrast, the 30-day volume is more important for long-term analysis, as it helps identify structural changes within market cycles. This metric often reveals assets with stable underlying support, as their trading volumes tend to decline less significantly relative to averages, even during bearish trends. Practical rule of thumb: middle cap and below, daily volume above $250 million, 30-day volume above $3 to $4 billion. Large cap and above, daily volume above $500 million, 30-day volume above $8 to $10 billion. Protocol revenue. Protocol revenue refers to the total income generated by a blockchain protocol over a defined period, daily, monthly, or yearly, through sources such as user fees, trading fees, service charges, interest spreads, liquidation penalties, and other protocol-level earnings. It represents the actual economic value captured from user interactions and on-chain activity within the system. This metric is an important indicator of a protocol's financial health, efficiency, and sustainability. It helps assess whether revenue is generated consistently or depends on short-term or sporadic usage, as well as how effectively the protocol converts user activity and engagement into real economic output. Over time, it can reveal patterns such as organic growth, cyclical demand, or sensitivity to broader market conditions. Protocol revenue is also widely used for benchmarking across projects and ecosystems. It enables comparison of different protocols within the same sector, helping to identify which ones generate stronger income and demonstrate better product-market fit. Additionally, it provides insight into how effectively locked liquidity, TVL, is being utilized, highlighting the protocol's ability to generate sustainable value relative to its capital base. Practical rule of thumb: growing revenue signals healthy demand and efficient TVL utilization. Stable revenue plus stable TVL, balanced and sustainable business model. Low or zero revenue, weak activity and inefficient liquidity usage. Comparison of revenue and market cap. This metric evaluates how well a project's market capitalization corresponds to the actual revenue generated by the protocol. In other words, it shows how efficiently the invested capital is being utilized relative to the income produced. For early-stage projects in development, low revenue is not necessarily a critical issue. However, it requires continuous monitoring and careful analysis of trends. In contrast, for more established projects, a low revenue-to-market cap ratio may indicate weak market adaptation, an inefficient business model, and potential risks for investors. Practical rule of thumb: above 10%, the protocol generates strong revenue. The economic model appears robust and stable. 5 to 10%, medium level of profitability. Below 5%, low revenue efficiency, which may indicate an ineffective economic model and increased investor risk.
Active engagement metric. Active users. The user engagement metric reflects the number of individuals who regularly interact with the protocol or participate in its ecosystem. This indicator is important not only for assessing the scale of a project, but also for understanding the quality of user activity, which directly impacts the sustainability of the business model and the protocol's potential revenue generation. User engagement is typically analyzed through two core metrics: DAU, daily active users; MAU, monthly active users. The DAU/MAU ratio helps evaluate how frequently users return to the protocol and how strong user retention is within the ecosystem. A higher ratio indicates regular product usage, while a lower one may suggest sporadic or event-driven interest. At the same time, it is important to note that low engagement is not always a critical red flag on its own. In many cases, the key factor remains the protocol's ability to generate revenue. If a project maintains stable income even with a limited number of active users, this may indicate an efficient business model and long-term resilience. Practical rule of thumb. Above point 4, high activity and strong user engagement. Point 2 to point 4, normal engagement with a stable user base. Point 1 to point 2, weak engagement, irregular user retention, elevated risk. Lending sector project evaluation metrics. This sector is focused on lending and liquidity management, so its evaluation should be based on how efficiently protocols utilize deployed capital and how consistently they operate within the broader ecosystem. Utilization rate/active loans. This metric reflects what portion of the total value locked in a lending protocol is actually deployed as active loans. In simple terms, it shows the ratio between the total amount borrowed and the total assets supplied to the protocol. This makes it a direct measure of how effectively deposited capital is being put to work. This metric is specific to lending platforms and DeFi credit protocols, and it serves as a key indicator of capital efficiency. The higher the utilization rate, the larger the share of locked capital actively generating yield through interest payments and fees for both lenders and the protocol itself. It also often correlates with higher borrowing demand, which can drive dynamic interest rate adjustments within the protocol. At the same time, an excessively high utilization rate sustained over a long period may signal potential liquidity constraints. If TVL is not growing, the protocol may lack sufficient available liquidity to process withdrawals or issue new loans, increasing risk for both borrowers and liquidity providers. In extreme cases, this can lead to sharp interest rate spikes or reduced accessibility to credit. This becomes particularly evident during periods of declining market activity or heightened volatility. To avoid misleading conclusions, it's important to evaluate this metric over time, ideally across a 1 to 2 year horizon. This approach accounts for market seasonality, cyclical demand for borrowing, and the overall resilience of the protocol's business model. Practical rule of thumb. 1. 70 to 90% efficient capital utilization, high activity. 2. 40 to 70% balanced level with available liquidity for growth. 3. Below 40%, low capital efficiency, requires deeper analysis of underlying causes. Staking sector project evaluation metrics. The staking/liquid staking sector plays a critical role in accumulating and efficiently distributing liquidity within the digital ecosystem. It enables users to earn yield while maintaining asset liquidity, making these protocols attractive to both investors and passive market participants.
When conducting analysis, it's important to clearly define the perspective from which the evaluation is being made. Two primary viewpoints should be distinguished. Investor, evaluating the purchase of a staking protocol token. User, planning to allocate assets into a staking protocol to generate passive income. In the first case, the key focus is on the total value of assets deposited into the staking protocol, as well as the growth dynamics of those inflows. Assets staked, total value staked, TVS. This metric reflects the total value of assets deposited by users into staking through liquid staking protocols. It serves as a key indicator of user trust in the protocol and its ability to generate yield for participants. The higher the TVS, the more capital is actively deployed within the protocol. In most cases, this signals a more stable business model and a higher probability of consistent, long-term returns for users. Assets staked growth rate. This metric reflects how dynamically the volume of assets allocated to staking changes over a given period, typically monthly. It's calculated using the formula above. It's important to focus on organic growth, excluding short-term incentives and seasonal spikes. This helps distinguish sustainable long-term protocol growth from temporary liquidity inflows. Practical rule of thumb. Above 20%, aggressive growth, often driven by campaigns, e.g. airdrops, or new integrations. 5 to 20%, stable capital inflow, indicating healthy user interest, especially during weaker market conditions. 0 to 5%, baseline activity, may signal stability, but also potential stagnation if sustained over time. Lack of growth over extended periods may indicate risk and should be benchmarked against competitors. In the second case, when the goal is to identify a reliable staking protocol for passive income, the key metric becomes the staking ratio. A higher volume of staked assets reflects stronger user trust and deeper liquidity, which is particularly important for efficient position exits.
Staking ratio. This metric reflects the share of tokens that are currently staked or delegated within the network. It indicates what portion of token holders actively participates in maintaining network operations and indirectly reflects the network's stability and reliability. A high staking ratio typically means that a significant number of participants are committed to the long-term development of the project and are willing to lock their assets to support the network. This enhances security by making potential attacks more difficult and reduces the amount of tokens available for speculative pressure in the market. In addition, strong staking participation often signals trust in the protocol and its economic model. Conversely, a low staking ratio may indicate that token holders are not interested in long-term engagement or are focused on short-term market opportunities. This can lead to increased volatility, lower security, and higher centralization, especially if a large share of tokens is concentrated among a few participants. The metric is calculated as the percentage of tokens that are staked or delegated relative to the total circulating supply. As such, it helps evaluate not only the current level of user participation, but also the overall quality of token distribution and community involvement in supporting network infrastructure. Practical rule of thumb. A higher staking ratio generally indicates a more committed community, stronger security, and better decentralization. A lower ratio may signal weaker holder engagement, potential centralization, and elevated network security risks. Staking yield, or annual percentage yield, APY.
This metric reflects the annual return from staking a token and serves as a key indicator when evaluating an asset's attractiveness for passive income. When analyzing APY, it's essential to consider the real reward rate, or RRR, which adjusts returns based on the protocol's current inflation rate. A high APY does not necessarily mean staking is profitable, especially if the protocol's economic model leads to sustained token inflation over time. In such cases, the real return for participants may be significantly lower than expected. Using annualized APY helps smooth out seasonal yield fluctuations, assess average profitability, and incorporate inflation dynamics into the analysis. This provides a more accurate framework for long-term investment decisions and allows for a clearer view of real returns or potential losses. Practical rule of thumb: 2 to 8% stable and moderate annual yield. 10 to 15% higher risk, often dependent on market conditions and seasonal dynamics. Above 15% high risk yield, frequently driven by aggressive incentive programs or short-term liquidity campaigns.
Exit liquidity. Liquidity. A metric that reflects the available liquidity within staking protocols and determines how quickly and with minimal loss a user can exit a position. In traditional staking, assets are typically locked for a fixed period, whereas in liquid staking, derivative tokens, such as STH in Lido or MSOL in Marinade, are used, which can be freely traded or deployed across DeFi protocols. Practical rule of thumb: high reserves, minimal risk, and fast exit from staking. Medium reserves, acceptable risk level with active position management. Low reserves, elevated risk, best suited for smaller allocations. Project evaluation metrics for the infrastructure and bridges sector. When evaluating projects in this sector, primary focus should be placed on the stability of protocol usage and the volume of liquidity flowing through their infrastructure. These indicators help assess the project's level of integration, its role in facilitating liquidity movement across networks, and the degree of interaction with major ecosystems and key market participants that drive core capital flows. Cross-chain volume. Transfer volume. The total value of assets transferred between blockchains via a bridge or other cross-chain infrastructure service over a specific period: daily, weekly, monthly, or quarterly. Practical rule of thumb: consistently high volumes typically reflect strong user trust and reliable infrastructure. Sharp spikes or drops may point to seasonal liquidity shifts, speculative activity, or technical limitations in handling large transaction volumes. Evaluation should be conducted over a period of at least 1 quarter. Transaction count. A metric that reflects the number of confirmed transactions processed through the smart contracts of a bridge or other infrastructure service over a given period. Practical rule of thumb: a high and stable transaction count typically reflects consistent real user engagement with the network. Sharp increases or declines may signal seasonal factors, speculative activity, or infrastructure throughput constraints. Developer activity. A metric that reflects the level of developer engagement in maintaining and advancing a protocol. For bridges and infrastructure solutions, this metric is particularly critical, as these services handle significant volumes of assets daily, making them key points of risk within the ecosystem. The development team plays a crucial role in maintaining protocol security, promptly identifying and mitigating vulnerabilities, and ensuring stable infrastructure performance. Practical rule of thumb: a high level of developer activity indicates continuous project support, regular security updates, and ongoing feature improvements. This reduces the likelihood of technical failures and enables a rapid response to potential threats. Activity below the annual average suggests potential project stagnation, especially if the decline persists over time This is a clear signal of elevated risk. Within large ecosystems, a temporary decrease in developer activity may be acceptable only after the completion of major milestones or strategic phases outlined in the project's roadmap.
Project evaluation metrics for the real-world assets segment. When evaluating projects in this segment, it is advisable, already at the initial stage, to develop a basic understanding of their partnerships with major companies or global capital management players. This makes it possible to quickly identify which types of real-world assets the protocol is focused on. Some projects may specialize in bond tokenization, others in real estate or commodities, while more advanced solutions span multiple asset classes simultaneously, such as bonds, real estate, equities, commodities, or private credit. This approach significantly simplifies the initial assessment, as it allows you to focus on large-scale partnerships and the real potential for asset tokenization. If preliminary information is limited, the evaluation should begin with an analysis of the total volume of tokenized real-world assets within the protocol. After this initial overview and the application of key metrics, it becomes possible to form a deeper and more objective understanding of the current state and future outlook of this segment. Total market size, total RWA value market. A metric that reflects the current structure of the entire tokenized real-world assets market, including real estate, bonds, commodities, and other financial instruments. It represents the total value of already tokenized assets and helps assess the scale and current state of the RWA market. At present, the majority of the tokenization market is concentrated in the private credit segment, indicating strong investor demand for this particular asset class. At the same time, there is a gradual increase in interest in tokenized U.S. Treasury debt. Demand for tokenized commodities and institutional funds is still in an active development phase and shows significant potential for future growth. Meanwhile, tokenization of equities and non-U.S. government debt, stocks and non-U.S. government debt, remains at an early stage, highlighting substantial upside potential in the future. Some other real-world asset classes are also still in the early stages of adoption, but maintain strong long-term development potential. Corporate bonds. Practical rule of thumb. Overall market growth is a positive signal of sector development and increasing investor confidence. A decline may indicate reduced interest in tokenization and is often associated with seasonal fluctuations or capital outflows. It is also important to consider sector-level dynamics relative to each category's overall market share. Total value by networks. Total RWA value by networks. This metric reflects the total value of tokenized real-world assets distributed across blockchain networks. It allows you to identify which networks lead in RWA volume, track growth or decline trends, and compare each network's share within the overall tokenized asset market. After analyzing the total RWA market, it becomes important to focus on the blockchain networks most actively involved in tokenization. Currently, the majority of tokenized real-world assets are concentrated on the Ethereum network, confirming its dominant position. This reflects a high level of ecosystem maturity, a broad set of available tools, and the infrastructure capacity required to scale the RWA market. The ZK Sync network also demonstrates a strong position,
reflecting growing user trust and active adoption of Layer 2 solutions. This highlights the practicality of its architecture and the availability of tools well suited for real-world asset tokenization. Other networks, Aptos, Solana, Stellar, Polygon, and Arbitrum, are currently in the early stages of RWA infrastructure utilization. This indicates a gradual expansion of the market beyond Ethereum and the emergence of a more diversified ecosystem, where new growth centers may develop over time. It is also important to consider which networks leading market participants choose for asset tokenization, as this serves as an indicator of reliability, technological maturity, and future capital inflow potential. Practical rule of thumb. Growth in an individual network's RWA share indicates increasing trust from issuers and users, greater infrastructure utilization, and strengthening role within the tokenization ecosystem. A decline in share, conversely, suggests weakening network positioning, potential outflows of projects or capital toward competing blockchains, as well as technological or regulatory constraints that may limit future growth potential.
Asset classes by network. Asset class by network. This metric shows which classes of real-world assets are being tokenized within a specific blockchain network and in what volumes. It helps assess the level of diversification in tokenization, the network's development potential, and the risk of dependency on a single market or sector. A deeper understanding of this metric enables a more comprehensive analysis of the structure of the entire tokenized economy. If one asset type dominates within a network, for example, real estate or debt instruments, it creates concentration risk. Any issues in that sector could significantly impact the entire ecosystem. In contrast, broad representation of different asset classes, from real estate and commodities to financial instruments and receivables, indicates infrastructure maturity and its ability to adapt to market changes. The importance of this metric also lies in its ability to reflect the real level of blockchain integration into the traditional economy. The greater the number and diversity of tokenized assets, the more the industry transitions from experimental use of the technology towards its practical application in global financial systems. Analysis of the tokenization structure within the Ethereum network shows that the key asset classes are U.S. Treasury debt and commodities. This indicates a focus on stable, high-trust instruments. Institutional funds are represented at lower volumes, while all other asset classes account for only a small share of the market and remain in early development stages. In the zk-Sync network, the dominant tokenized asset class is private credit, indicating a clear focus on this segment. Institutional funds also play a significant role, while U.S. Treasury debt and stablecoins are represented at lower volumes. This structure reflects an orientation towards financial and investment products with moderate risk and potentially higher returns. After a general overview of blockchain networks involved in RWA tokenization, a deeper analysis of each network helps identify its strategic focus, which asset classes it specializes in, how diversified its tokenization structure is, and which segments have the highest growth potential. Comparing different networks in this context highlights differences in their approaches. Some focus on stable and institutional-grade assets, forming the foundational infrastructure of the market, while others target more niche or dynamic segments with higher risk and potentially higher returns. Collectively, these differences do not indicate competition, but rather the formation of a complementary ecosystem, where different networks serve different needs of participants in the tokenized real-world assets market. Practical rule of thumb. The dominant asset class reflects the primary focus and strategic direction of the network. Medium volume classes indicate segments with growth and diversification potential. Low volume classes are typically emerging areas, still in early stages of development.
Ultimately, analyzing the structure of tokenized assets helps not only evaluate the current state of a network, but also understand its long-term resilience, development direction, and ability to withstand market volatility. Asset issuers. This metric reflects the number of companies or funds engaged in real-world asset tokenization, as well as the number of unique addresses that hold or service these tokens. Analyzing it both at the overall market level and across individual blockchain networks helps identify key participants in the ecosystem, understand their specialization by asset class, and determine their choice of infrastructure for product deployment. A deeper examination of leading entities under this metric also helps reveal the most active market segments and the strategic approaches of issuers, specifically whether they focus on building within a single network or adopt a multi-chain strategy to reduce risk and expand liquidity access. For example, let us consider the company Paxos. Based on the available data, we can observe the number of issuing companies, as well as the number of unique addresses across different blockchain networks involved in the tokenization process. This provides a foundation for further detailed analysis of each company based on the following key aspects. Which networks are being used? Which asset classes are being tokenized? The level of diversification. According to the available data, Paxos is focused on tokenizing two asset classes, stablecoins and commodities. Tokenization is carried out on two networks, Ethereum and Solana. The total number of unique smart contract addresses is 9. Additionally, the dataset provides a list of digital products created by the company, offering insight into the scale and structure of its operations. Practical rule of thumb. When analyzing an issuer, it is important to systematically identify which asset classes it tokenizes, which blockchain networks it uses, the number of unique addresses, and the number of products it has issued. Issuance volume. This metric reflects the total amount of new assets tokenized by a protocol over a given period. It is not merely a numerical indicator, but a reflection of market activity and a signal of demand for real-world asset tokenization. The largest contribution to overall issuance volume comes from U.S. Treasury debt and private credit. Government bonds showed peak volumes in January and March, with a temporary decline in February. Private credit grew in January-February, while momentum slightly slowed in March. Below are the data on tokenized issuance volumes for the first 3 months of 2025. Other asset classes, commodities, stocks, and institutional funds, showed moderate issuance volumes, indicating cautious interest and significant potential for further growth. This dynamic may suggest that these segments are still in the early stages of market formation, where participants are actively assessing risks and the efficiency of available instruments. If demand stabilizes, these categories may become new growth drivers in the medium to long-term horizon. Practical rule of thumb. The main market drivers are assets with consistent issuance growth, as they indicate the direction of demand. Moderate volumes should not be ignored, as they may represent early-stage opportunities for future expansion. The distribution of issuance across asset classes helps assess market stability and its sensitivity to seasonal fluctuations.
Capital deployed. This metric shows how user funds are allocated across tokenized assets through various management platforms. Essentially, it represents investor deposits seeking yield, as well as an indicator of trust in infrastructure and demand for specific asset classes. Data over the past 365 days reflects the dynamics of capital inflows into tokenized assets. It allows tracking how volumes have evolved throughout the year and which projects have emerged as leaders in terms of deployed capital. This signals investor confidence and the strong positioning of leading platforms within the market. It is also important to note that capital growth dynamics tend to be cyclical. Inflows follow a wave-like pattern, with seasonal fluctuations and concentration of resources in a limited number of leading platforms that drive the overall development of the sector. Practical rule of thumb. Capital inflow trends over the year should be monitored, with a focus on identifying leading platforms and analyzing their volumes. High levels of deployed capital indicate investor confidence and platform stability. Wave-like dynamics point to seasonality and the emergence of broader market trends.
Assessment of potential risks. When analyzing crypto and blockchain projects, it is essential to consider the core risk categories that can significantly impact platform stability, security, and long-term development. Based on practical experience, 4 primary risk groups stand out as the most common and most critical for the entire industry. Technological risks. These include coding errors, security vulnerabilities, and potential exploits. They can lead to loss of user funds, protocol disruptions, and substantial financial damage to the platform. High hacker activity and weak internal security significantly increase exposure to these risks, and no project can be considered fully immune. Regulatory risks. These are associated with potential bans, restrictions, or new regulatory requirements across different jurisdictions. Such changes may limit platform functionality or restrict user access to certain services. At an early stage, it is important to evaluate the project's jurisdiction to understand potential regulatory constraints and assess long-term stability. While not all conflicts can be predicted, and their impact can be mitigated through proper compliance with regulatory standards. Market risks. These arise from shifts in investor sentiment, the emergence of new competitors, or macroeconomic fluctuations. They directly affect token demand, user activity, and price volatility. From a practical standpoint, macroeconomic conditions are often the most powerful driver. Despite control over other factors, they can still significantly influence project performance. Team and leadership risks. These are driven by the human factor. The departure of key team members or internal conflicts may result in development delays, poor decision-making, or a loss of strategic direction. These risks are often underestimated, yet even the loss of a single critical contributor can slow down development and call the platform's long-term viability into question.
Market assessment should begin with research and reports from leading digital asset management firms. Such materials are produced by experienced analysts with access to a broad range of tools, providing a more balanced and systematic perspective. It is useful to regularly study reports from companies managing crypto ETFs and ETPs, such as BlackRock, Grayscale, or CoinShares, and to complement this analysis with data from mining companies like Riot, Mara, or Iron. This helps build a comprehensive view of the ecosystem. Key metrics to monitor include the number of active addresses, transaction volumes, TVL, total value locked, token issuance dynamics, liquidity, and ownership structure. For systematic monitoring, it is advisable to use specialized analytics platforms, on-chain tools, and data aggregators. At first, this type of information may seem complex, but with practice, its interpretation becomes clearer and more effective. Broad market reviews should be conducted monthly in order to timely identify trend shifts and seasonal fluctuations. In parallel, individual projects and their ecosystem should be monitored. This includes evaluating performance, updating fundamental indicators, and tracking market developments such as investments, token unlocks, partnerships, or integrations. Such analysis is typically performed over a monthly horizon, with updates weekly or bi-weekly. It is also important to document findings in the form of short summaries or a monitoring journal. This helps track changes over time and improves the quality of future decisions. Prices and trading volumes of portfolio assets require daily attention. Roadmap updates, code changes, and reporting are logically reviewed on a weekly or monthly basis, while also accounting for the emergence of new competitors, regulatory changes, and macroeconomic factors.
For blockchain networks as the foundation of the ecosystem, the monitoring period should be extended to monthly or quarterly intervals to support more strategically sound decision-making.
The optimal monitoring frequency includes a yearly or quarterly horizon for evaluating ecosystems and blockchain networks, a monthly or weekly interval for project-level analysis and performance dynamics, and a multi-day interval for tracking token prices and trading volumes. Systematic monitoring allows you to stay close to the market and make informed decisions at a time when most participants react too late. Consistent work with high-quality sources, fundamental and market metrics, and flexible adjustment of monitoring frequency depending on an asset's role in the portfolio form the foundation of long-term resilience and effective risk management.
Part 5. Tokenomics. Tokenomics, a term combining token and economics, is the fundamental foundation of any cryptocurrency project. It is not merely a description of a digital asset's financial characteristics, but a comprehensive system of rules and mechanisms that defines how a token is created, distributed, and used, and how its long-term value is formed. Tokenomics should be viewed as the business model of a company, where every element is pre-programmed and serves a specific purpose. For early-stage investors, understanding this concept marks an important stage of development, a gradual shift from viewing cryptocurrencies as a game of chance to analyzing them as fully functioning economic systems. A solid grasp of tokenomics enables investors to evaluate a project's long-term sustainability rather than simply reacting to short-term hype. It reveals the ownership structure of an asset and shows how incentives are distributed among the development team, early investors, and the community, allowing one to assess whether stakeholder interests are aligned and whether the ecosystem maintains internal balance. It is also essential to analyze the token's life cycle, from issuance and unlock schedules to burn mechanisms or demand incentives. Poorly designed tokenomics, for example with excessive inflation or a high level of centralization, can destroy a project regardless of its technological advantages. In such cases, even a strong product may fail under economic pressure. This is why tokenomics analysis is one of the core tools of rational investing and a fundamental requirement for making well-informed decisions. Additionally, it is important to consider mechanisms that support token demand, such as utility functions, governance participation, or access to ecosystem services. At this stage, the perspective itself changes. Once cryptocurrencies are viewed as economic systems rather than speculative instruments, tokenomics becomes the first anchor point of analysis. It shows how a project creates value, how that value is distributed, and what incentives are embedded for users, investors, and the team. To properly interpret this system, one must start with its basic components. Core concepts of tokenomics. The type of token directly defines a project's economic model. If a token has a utility nature, tokenomics will focus on incentivizing its usage within the ecosystem. If the token serves a governance function, the model will encourage long-term holding and active participation in decision-making. Therefore, the first step in analyzing tokenomics is understanding the role of the token. In practice, the following types are widely used. Utility tokens act as the fuel of the ecosystem and provide access to the project's products or services. The more actively the network is used, the higher the demand for the token becomes, meaning the economic model is directly tied to real product usage. Governance tokens grant holders voting rights on protocol changes, resource allocation, or strategic upgrades. This model is typically oriented toward long-term holding or staking, as a user's influence depends on the number of tokens they hold. Investment tokens may provide rights to real-world assets or a share of projects' revenues. Their tokenomics is often designed with regulatory compliance in mind, making them more attractive to institutional investors, but also limiting model flexibility. Dual token models, dual tokens, commonly used in GameFi and complex ecosystems. In such systems, functions are split between two tokens. For example, in the Axie Infinity ecosystem, the AXS token is used for governance and staking, while SLP serves as an in-game currency. This approach reduces pressure on the primary token and clearly separates economic roles. Stablecoins occupy a special place in tokenomics. They are pegged to stable assets, most commonly the US dollar, and are designed to minimize volatility and to date prevent procedures from being interfered with.
The next step is understanding the core terminology that serves as the foundation for studying tokenomics and the structural design of crypto projects. Total supply, the maximum number of tokens that can exist within the network. Circulating supply, the number of tokens currently in the market and available for trading. Locked supply, tokens that are temporarily restricted from circulation to prevent excessive price pressure or inflation, especially during periods of market instability. Unallocated supply, tokens with no defined distribution schedule yet, which may only enter circulation once specific conditions are met. Unlocked supply, tokens that are eligible to enter circulation but have not yet reached end-user wallets, meaning they do not always match circulating supply. Available supply, tokens that may potentially enter the market directly or after certain conditions are met, representing an important factor in assessing future selling pressure. Untracked supply arises due to missing or unclear data regarding a portion of tokens. Emission, the process of introducing tokens into circulation according to tokenomics rules. It typically defines the volume of tokens released and the time frame over which they are unlocked based on a predefined schedule. Allocation and distribution structure. In simple terms, token allocation refers to the distribution of the total token supply among different stakeholders within a crypto project. It shows who holds economic control over the asset, how influence is distributed, and which priorities are embedded in the project's development model. Allocation is one of the key elements of tokenomics because it provides a complete picture of the project, who owns the tokens, which groups can influence decision-making, and how the potential for growth or risk is formed. In practice, each project may have its own allocation structure. The number of categories, their naming conventions, and level of detail often vary depending on the team's vision and how the model is described in the white paper. At the same time, groups with identical functions are often labeled differently, which complicates analysis and may create unnecessary confusion for investors. To simplify understanding and provide a universal evaluation framework, a standard approach to allocation breakdown is presented below, highlighting key structural categories and explaining their roles. The examples include common allocation labels frequently found across different projects. Despite differences in terminology, their functions and objectives remain similar according to general tokenomics principles. This approach helps investors navigate any project structure more easily, even if its allocation system is described in complex or unconventional language, and enables faster assessment of the balance between ecosystem participants.
In particular, it helps identify excessive token concentration within specific groups and potential centralization risks. Founder and team allocation covers tokens allocated to individuals responsible for building, developing, and maintaining the long-term growth of the project. This includes founders, core team members, key developers, advisors, and future employees involved in strategic management and technical execution. Functional purpose: this allocation combines short-term rewards for contributions to the project with long-term incentives through gradual token unlocks according to a vesting schedule. Analytical value: unlocks may occur daily, monthly, or quarterly, often preceded by a cliff period. This structure reduces sudden selling pressure and increases investor confidence. Transparent, long-term vesting signals a mature tokenomics design, demonstrating the team's commitment to ecosystem development rather than short-term profit realization.
Allocation also helps assess alignment between developers, users, and investors, as well as potential concentration risks. Documentation markers: founder, team, core contributor, and future employees. Private investors allocation allocated to venture funds and private investors who finance the project at early stages. This capital enables product launch, team formation, and initial infrastructure development. Functional purpose: private investors typically receive tokens at a lower price compared to public offerings to compensate for higher early-stage risk. However, these tokens are almost always subject to long lockup periods, cliffs, followed by gradual vesting, usually over 2 to 4 years. This creates long-term alignment between investors and the project's strategic development. Analytical value: this allocation helps assess token concentration among funds and potential selling pressure during future unlock events. It is a key indicator of balance between private capital, the team, and public markets, and may also signal the level of institutional confidence in the project. Documentation markers: strategic round, private sale, Series A, Series B, angel investors, venture capital. Public investors allocation comprises tokens distributed through open sales channels to a broad range of participants. Unlike private rounds, this allocation typically does not include long vesting periods, meaning tokens become tradable immediately after sale or listing. Functional purpose: the main goal of public allocation is to raise additional capital for project development and to build an active user community. Open sales increase project visibility, ensure broader token distribution, and create initial secondary market liquidity. Analytical value: it is important to evaluate how many tokens enter circulation immediately. A disproportionately large public allocation without stabilization mechanisms may lead to increased short-term volatility. A balanced structure, on the other hand, supports market stability and long-term community engagement. Documentation markers: whitelist, IDO, ICO, ILO, IEO, crowd sale, launchpad, coinlist. Reserved allocation includes tokens set aside for future recipients not defined at the project's launch. This reserve is typically controlled by the company, DAO, or a dedicated foundation, and is used strategically throughout the project lifecycle. Functional purpose: reserved allocation serves as a tool for long-term development and operational stability. It is used to fund product expansion, new feature launches, infrastructure maintenance, marketing initiatives, and unforeseen expenses. It is often labeled as ecosystem allocation and used for developer grants,
strategic partnerships, and ecosystem incentives. Analytical value. The key factor is transparency in reserve management. A large reserve with clear usage rules creates centralization risks and potential market influence. In contrast, formalized governance mechanisms, especially DAO-based decision-making, are a positive indicator of mature tokenomics and sustainable ecosystem development. Documentation markers: foundation, treasury, endowment, ecosystem, marketing, nonprofit foundation, strategic reserves. Community allocation includes tokens dedicated to incentivizing user participation and ecosystem growth. This allocation plays a critical role in building an active and loyal community that not only uses the product, but also contributes to its testing, development, and adoption. Functional purpose. Tokens are used to reward early users, incentivize staking, support testnet participation, liquidity programs, and other forms of active engagement. This aligns incentives between the project and its users, strengthening network effects. Analytical value. When evaluating this allocation, it is important to consider the scale, duration, and structure of reward programs. Overly aggressive incentives may create short-term price pressure, while a balanced approach supports organic growth, user retention, and long-term ecosystem stability. Documentation markers: airdrop, liquidity mining, staking rewards, bounty program, contest, initial LP. Other allocations covers specialized token distribution categories that fall outside the core allocation types and are defined individually depending on the project's needs. Their purpose is typically described in detail in the white paper or technical documentation. Functional purpose. This category may include tokens for liquidity provision on DEXs and SEXs, licensing models, donations, strategic partnerships, or other non-standard use cases. Such allocations improve operational flexibility, help reduce price volatility during large transactions, and support market stability. Analytical value. It is important to assess how clearly these tokens are governed and how transparent their usage rules are. Vague or overly broad definitions may hide potential risks of additional market pressure. Documentation markers: liquidity, DEX SEX, licensing, donations, special purpose allocation.
Now it is important to become familiar with the typical percentage distribution of tokens within a crypto project. These standard ratios form a baseline understanding of a healthy and balanced allocation structure. They help investors quickly orient themselves during the initial project evaluation and determine whether a project's tokenomics aligns with generally accepted market standards and practices. The data presented for 2022 to 2024 reflects the average token distribution in projects launched during this period. This statistic provides insight into real industry practices and allows comparison with standard allocation models. Such analysis helps identify which tokenomic approaches dominated in recent years and whether a specific project aligns with these trends or deliberately deviates from them. This analysis helps understand which approaches have been dominant in token economies over recent years and how closely a given project follows these trends or intentionally diverges from them. Founders and the team typically receive 15 to 25% of the total token supply, averaging around 20%. The share allocated to early investors varies more widely, from 5% to 25%, with an average of approximately 16%. Public investors usually account for a smaller portion, around 5 to 10%, with an average of about 4.6%. The largest portion of tokens in most projects is allocated to the community, on average around 37%, reflecting a focus on ecosystem development and long-term incentives. The reserve allocation typically ranges from 15 to 25%, while other auxiliary categories account for approximately 5 to 10%, depending on project specifics. It is interesting to note that in most cases, reserves were positioned toward the upper end of the range,
while community allocations were reduced. In the context of the market, this reflects the conditions of limited liquidity and challenging market environments that emerged in 2022.
This indicates a shift toward a more conservative strategy. Teams aimed to build additional reserves to ensure project sustainability, cover operational costs, and maintain stability in order to achieve long-term goals in an unfavorable environment. In contrast, during bull markets, the strategy takes a different form. As observed in periods of strong growth, most teams prioritize community expansion. As a result, a larger share of tokens is allocated to staking, liquidity provision, and airdrops, which stimulate user activity and expand the ecosystem. This approach builds trust and community loyalty, keeping users engaged within the project and strengthening long-term support. From a personal analytical perspective, when evaluating new projects, it is essential to pay attention to the structure and grouping of token allocations. In practice, this allows for a quick identification of key token holders, an assessment of distribution balance, and an understanding of whether the team is laying the foundation for long-term project development. When analyzing token allocation, the first step is to assess the overall quality of the tokenomics structure. Healthy tokenomics model. A significant portion of tokens, often more than 50%, is allocated to the community. This approach ensures broad token distribution, strengthens decentralization, and reduces the risk of market manipulation. Another strong signal is the presence of clear and long-term vesting schedules for the team and early investors, which reflects accountability from the development team and a commitment to the project's long-term growth. Equally important is a balanced allocation across all categories, without excessive concentration in a single group. This creates a more resilient economic model and reduces dependency on any single stakeholder, making the ecosystem more stable over time.
Risky tokenomics model. One of the primary red flags is an imbalanced allocation where the team and advisors control more than half of the total token supply. Such a structure often signals high centralization and a potential risk of market pressure from insider holdings. Another concerning indicator is a low community allocation. If users are assigned less than 30% of the total supply, their incentive to actively participate in and support the ecosystem significantly decreases, which can weaken long-term growth dynamics. The size of the treasury or reserve allocation is also critical. When less than 20% is dedicated to ecosystem development, it limits the project's ability to fund infrastructure, marketing, and future expansion. An additional risk factor is the absence of transparent vesting schedules or overly short unlock periods. This can lead to sudden supply shocks and increased volatility due to large-scale token releases entering the market at once. In summary, the token allocation structure is one of the key indicators of decentralization and the overall health of a project. For investors, it serves as a signal of whether the team is building a sustainable long-term economic model and ecosystem, or focusing primarily on short-term value extraction.
Vesting and token unlock mechanics. In the previous section, we examined how tokens are distributed among different participant groups. However, it is important to understand that this allocation does not imply immediate access to all assets. In most projects, a significant portion of tokens is initially locked, and full ownership rights are granted gradually over time. This process is implemented through a dedicated mechanism called vesting, which defines the schedule and pace of token unlocks for each category of participants. Vesting plays a critical role in balancing the interests of the team, investors, and community, while also reducing the risk of sudden market pressure. Vesting is a mechanism in which tokens allocated to specific parties, such as the team, investors, advisors, etc., are not released immediately, but instead are gradually unlocked over a predefined period according to a predetermined schedule.
The primary purpose of vesting is to maintain economic stability within the project, prevent sharp price fluctuations, and incentivize long-term commitment from all participants. Cliff period, an initial waiting period during which tokens remain fully locked. Only after this phase ends does the unlocking process begin. Cliff unlock, the first one-time release of tokens after the cliff period ends. It typically involves unlocking a portion of the allocation, for example 10 to 25%, and serves as the starting point of the vesting schedule. Linear unlocking, the next stage, during which tokens are released in equal portions at regular intervals. Unlocks may occur daily, weekly, monthly, or quarterly. This approach ensures predictability in token supply and reduces the risk of sudden market pressure. In some projects, the unlock schedule may be adjusted by the team itself or through DAO governance mechanisms. In such cases, vesting can take not only a linear form, but also an adaptive or variable structure, allowing it to respond to market conditions and the state of the ecosystem. Unlock schedule, a predefined plan that outlines when, how frequently, and in what amounts tokens become available to different participant groups. It reflects the time-based distribution of tokens, including cliff periods and gradual vesting stages, and allows for the assessment of potential market pressure and price volatility risks. In practice, an unlock schedule typically works as follows. Investor agreements often include a cliff period, for example, 12 months. During this time, neither investors nor the team have access to their tokens, meaning they cannot sell them. After the cliff period ends, an initial portion of tokens, for example 25%, is unlocked at once, while the remaining tokens are gradually released through a linear schedule over a defined period. Additionally, vesting not only restricts token access over time, but also serves as a mechanism for aligning incentives among all project participants. Clearly defined unlock conditions increase supply predictability, reduce speculative pressure, and allow investors to evaluate the potential impact of future emissions on price and liquidity. Conversely, a lack of transparent vesting or overly short vesting periods may signal elevated risk and a weak long-term commitment from the team. Below is a typical example of a standard token unlocking schedule.
In the diagram, different participant groups are highlighted by colors, making their allocation shares immediately visible. The line chart illustrates the start of token unlocking after the cliff period, June 1st, 2024, and the gradual distribution of tokens over the 2024 to 2028 period. In addition, users can select any date to see what portion of tokens has already unlocked, as well as how they are distributed among participant groups at a specific point in time. Token unlocking can occur daily, weekly, or monthly in equal installments, and may last from 1 to 4 years or more. This approach allows for a smooth distribution of token supply over time, and reduces the impact of large individual unlock events on market dynamics. The unlock schedule serves several key functions. It prevents a simultaneous release of many tokens onto the market, which could sharply depress the price. It ensures long-term alignment of incentives for the team and investors, as their potential returns are directly tied to the future growth of the token's value. The table below shows the average vesting duration for different participant groups in projects launched between 2022 and 2023. As can be seen, a significant portion of team and early investor tokens is gradually unlocked over a period of up to 4 years.
This reflects most of the project's orientation toward long-term development. Community and reserve tokens are typically locked for periods exceeding 2 years, which demonstrates projects' intention to maintain an active user base and pre-allocate resources for ecosystem incentives even during cyclical market downturns. Additionally, this structure allows teams to respond flexibly to changes in market conditions without making abrupt structural adjustments to tokenomics. Interpretation of tokenomics models. Now we move to the question of how to properly use the unlock schedule. On its own, an unlock schedule is simply a visualization of when and how tokens enter circulation. Its real value emerges only when we know how to interpret this data correctly. Below, based on practical experience, we examine the logic of evaluating different unlock structures and vesting periods. By analyzing an unlock schedule, investors can gain meaningful insights into a project's strategy, potential risks, and long-term ecosystem design. Unlock schedule defines the rules and paths at which tokens enter circulation over time. It is one of the core mechanisms of tokenomics, directly influencing market dynamics and participant behavior. Additionally, it shapes market expectations regarding future supply, which has a direct impact on liquidity conditions and overall volatility. Functional purpose? The unlock schedule controls token supply in the market, reducing the risk of sudden liquidity shocks, while also creating long-term incentives for the team, investors, and the community.
Types of unlock schedules. Linear vesting. Tokens are released in equal portions throughout the entire vesting period. This model creates predictable supply dynamics and reduces the risk of sharp price fluctuations. Non-linear vesting. Token release is uneven, often structured as large one-time unlocks. This can create sudden selling pressure and higher volatility, especially in low liquidity conditions. Analytical value. Analyzing unlock events allows investors to anticipate potential risks in advance. It is important to track key unlock dates and compare released volumes to the project's market capitalization. Price fluctuations are often observed several days or weeks before and after unlocking events, ranging from short-term dips due to profit-taking to speculative price spikes. Evaluating unlock volume in USD terms helps more accurately forecast volatility and adjust investment strategy in a timely manner. Cliff duration. The cliff acts as a protective mechanism in tokenomics, defining an initial full lockup period before any gradual vesting begins. Functional purpose. For the team, encourages long-term commitment rather than short-term profit-taking. For investors, ensures early-stage participants cannot immediately exit after token listing. For the market, reduces the risk of large token dumps during volatile periods, supporting relative price stability. Analytical value. A longer cliff period increases investor and user confidence and signals a project's long-term orientation and economic stability. Optimal range, typically 12 to 18 months. The absence of a cliff or a full 100% unlock at launch significantly increases short-term market risk.
Cliff unlock defines the first tranche of tokens available to the team or investors after the cliff period ends. Functional purpose provides initial access to tokens after the lockup period ends, allows the market to gradually absorb new supply. Analytical value. The initial unlock typically represents a significant portion of the allocation, 10 to 25%, allowing investors to evaluate participant behavior and potential market impact. Excessively large unlocks at this stage can create short-term selling pressure. Optimal range. 10 to 25% of total allocation released once, immediately after the cliff ends. Linear unlock represents a steady release of tokens into circulation after the cliff period, distributed evenly over time. Functional purpose ensures predictable token flow into the market, reducing volatility. Aligns incentives by encouraging long-term participation from teams and investors. Analytical value shows how token allocation is distributed over time after the initial cliff unlock, helping assess long-term supply pressure and incentive alignment. Optimal range, 1 to 4 years, with release intervals that may be daily, weekly, monthly, or quarterly.
Total vesting duration represents the full period over which tokens are gradually unlocked after the cliff phase. Functional purpose
controls token supply entering the market, and reduces sharp price fluctuations. Incentivizes long-term engagement from the team, investors, and community. Analytical value. Vesting shorter than 12 months increases the risk of rapid token release and reduces investor confidence. Vesting longer than 60 months may weaken team motivation and slow down ecosystem development. Shows how token allocation is distributed over time after the initial cliff unlock, helping assess long-term supply pressure and incentive alignment. Optimal range, 24 to 48 months. Unlock progress. Shows what portion of the total token supply has already entered circulation and how far the vesting process has progressed. It helps assess the potential impact on price and liquidity under different market conditions. Unlocked, 0 to 10%. Bear market, weak cycle. Most tokens remain locked. There is a high probability of selling pressure during future large-scale unlock events. Bull market, strong cycle. Stability is still not established. The ecosystem is in an early development stage.
Unlocked, 25 to 50%. Bear market, weak cycle. A portion of tokens is already circulating, creating moderate downward pressure on price. The market is gradually adapting, but short-term volatility risks remain around large unlock events. Bull market, strong cycle. Unlocked tokens support liquidity and user activity. Volatility risk is lower, and unlocks can contribute to organic price growth. Unlocked, 50 to 80%. Bear market, weak cycle. A significant share of tokens is already in circulation, but residual supply pressure still exists. Price may fluctuate during major unlock events. Bull market, strong cycle. Token availability supports liquidity and ecosystem activity, fostering growth. Volatility risk is moderate. Unlocked, 100%. Bear market, weak cycle. Vesting is fully completed, and there is no additional unlock-driven pressure. Price valuation is primarily based on fundamental metrics. Bull market, strong cycle. The project operates in a stable environment with maximum liquidity, and price is driven by demand and intrinsic value, rather than token unlock mechanics. TBD, 0 to 10%. Bear market, weak cycle. The portion of undefined tokens is minimal, so price pressure risk is moderate. However, investors should still account for possible future emissions. Bull market, strong cycle. Limited reserves support project development without a meaningful impact on market stability. Bear market, weak cycle. A significant share of tokens remains undefined, creating moderate to elevated risk of sudden selling pressure once emissions are activated. Bull market, strong cycle. Reserves may support ecosystem growth and incentives, but short-term volatility risk increases. TBD, 50 to 80%. Bear market, weak cycle. A high level of uncertainty creates substantial risk of future market pressure if token issuance is realized. Bull market, strong cycle. Reserves can enable strong scaling potential, but large unlock events may trigger noticeable volatility. TBD, 100%. Bear market, weak cycle. Full uncertainty regarding token distribution creates maximum risk for price stability and investor confidence. Bull market, strong cycle. Strong potential for future growth exists, but a lack of transparency can lead to sharp and unpredictable price fluctuations. Token unlocks, market dynamics by group allocation.
Investors can compare unlock dynamics across allocation groups with market capitalization and token price behavior to assess the influence of each participant category in the short and medium-term perspective. Functional purpose. Analyzing unlock schedules by allocation groups makes it possible to identify periods of increased volatility and determine which participants, team, investors, community, reserves, are likely to exert the strongest market impact at specific points in time. Analytical value. Helps identify periods of potential selling pressure on price. Assists in evaluating potential liquidity stress and adjusting investment strategies in advance of key unlock dates. Enables detection of risks related to simultaneous large-scale token releases entering the market.
Token unlocks. Market dynamics by category. This metric allows investors to analyze the impact of token unlocks across different market segments and incorporate these insights into investment strategy formation. Functional purpose. Category-based analysis helps identify which types of allocations create the greatest market pressure during specific periods. Analytical value. Identifies categories that increase overall market volatility, enables forecasting of combined impact on market conditions and liquidity, improves risk management by focusing attention on the most influential segments. Token unlocks, market dynamics, enables the assessment of how large-scale token releases impact the market across different time horizons. Functional purpose. Monthly dynamics provides a granular understanding of short-term effects of token unlock events on market activity, liquidity, and price behavior. Quarterly dynamics allows tracking the concentration of unlock events from a mid-term perspective. Annual dynamics forms a high-level view of structural market pressure. Elevated unlock volumes in specific years may create sustained long-term downward pressure on price. Analytical value. High concentration of unlocked tokens within short timeframes signals potential selling pressure on price. Helps anticipate volatility waves and optimize timing for entering and exiting positions.
Key takeaways from the chapter. Market noise and background hype. Maintain rational judgment and a neutral mindset when facing loud narratives and hype-driven assets. These often create a false sense of missed opportunity and push investors towards emotional decisions. Learn to separate meaningful signals from noise and think strategically by asking the right questions instead of reacting impulsively. Narrative evaluation. Do not rely on mass top project rankings or trending lists. Instead, focus on analytical reports, research papers, and insights from leading funds and major industry players. Study which problems are being solved across existing market segments, what new solutions are emerging, and which niches remain underserved. This approach helps identify long-term trends and uncover projects that genuinely add value to the ecosystem. Comprehensive project research. Evaluate both new and existing projects, especially at launch and during early-stage development. Use a broad set of metrics to track growth dynamics and the stability of the economic model. Maintain continuous monitoring and regularly update key data points to support informed, well-reasoned decision-making.